Welcome, everybody. My name is Alesh Eisner of the Canadian Money Talk. This is my friend Rob of the Mindful Investor. And welcome to part two of our personal finance podcast, if you will. So we will begin where we left off previously. We're going to start on question number 8. And if you haven't had a chance to look at the first part of our podcast, please make sure you do that.
What
Okay.
would you tell someone who is trying to achieve financial independence? Do you have any advice for them?
Yeah, so for financial independence and the retire early aspect, those are obviously two separate items. Uh, I think living below your means, delaying gratification, saving as much as possible. Even the experts say 15% of your gross income. I'm like, well, that's if you want to retire at 65, you're fine. If you want to retire earlier or do a hobby for the rest of your life, uh, then you need to save more. And yeah, most people don't even do the 15%. I think the Canadian average is like 5 or 6. Like it's not even 15. And of course, starting investing. Take some educated risks when you're investing. If you don't trust yourself to invest in a lump sum, then do it every month using dollar cost averaging and do the pay yourself first. Uh, how much you get to invest depends on the combination of income minus expenses. So you need to increase your income or decrease your expenses. Your choice, and if you can do both, great. Avoid lifestyle creep as you get a raise. Don't think that you're now rich and you deserve a better lifestyle. You can always outspend whatever income you have, guaranteed. Educate yourself about investing and personal finance. They're very important topics. I'm sure every teacher, going back to that, thinks that whatever they're teaching is super important. But yeah, I think finance can change your life. Read a few basic books, become interested. I have friends who research their next truck or their next TV uh, for hours, days, and then they go to a random financial advisor who's at the branch on a Saturday morning, and they give them their money, and they just do it blindly. And they're like, yeah, that mutual fund sounds good, sure. Uh, and then for financial independence, I think maybe the most important is to have multiple streams of income. So have your dividends, have your rents. If you're actively working, have your active work income, capital gains from trading, if that's what you're doing. If you, as you said, if you want to do training videos, ebooks, everybody everybody has a book in them, I heard. You can't stop working if your job is your only source of income. Like a lot of people are screwed if they get laid off after a couple of months. Their savings are gone, and if you have multiple streams of income, you're like, great. I'm gonna jack up the one of the side hustles, and off I go. And I'll still look for a job, but it's not gonna land me on the street. So yeah, multiple sources of income I think would be the biggest piece of advice. So what about you?
I think you hit a lot of my points as well.
Sorry.
It's pretty much like a broken record. Like to like most of us who have like studied this topic, is those 10-20 points is all the same. It's just worded differently by different people, but it's all based on the same type of principle. So just make sure you make more, save less. And by saving, I don't mean like saving as in putting it into like a tax-free savings account and just parking it there. I know some people actually do that.
Yeah,
They
lots of
say
people do.
it's labeled the savings account, so I
Yeah,
put my savings there. I'm like, what? What are you doing? I just want to like slap them, but then but then I can't really teach them, and then I advise them to invest in something. It's like, oh, but it could go down. Okay,
Yeah,
but it can also go up. But they don't
yeah,
look at the outside. They just like, oh, but it can go down. Great. Yeah. So make more, save less. I think both of these parameters you can control. Like making more, like not just from your primary job. You can always look for side hustles. Like find something on Craigslist, resell it on eBay. Just try different things. Like there are so many side hustles. You go on YouTube, people say like there's 20 side hustles in year 2020. Look through a couple of them. Like some of them are ridiculous. You just watch videos and click on videos all day, and then you make some money. I don't advise you to do that, but there are a lot of good ones. I implemented maybe if I think of my like revenue streams, I've probably done like 20, 30 different avenues of income, and I can probably make videos out of that too. And living below your means, build your snowball at an early age, like even with like $50 or $100, because there are brokerages with like free commission right now. You can just buy a fractional share even. If you like Apple is what I don't know, I forgot, like 150, 100 right now.
yeah,
That's US dollars, but you can buy fractional, you can buy half a share of Apple. Like start, because once you start, you kind of pay more attention to it, and therefore you're more aware of the market and how this investment game works. Like winning or losing. Winning, you know, okay, so next year this Apple stock has grown 15%. Like, why did this happen? Like, what triggered all this? Like, is it just random? Or what if I bought like a wheat stock and it went down 50%? Like, why did that happen? Like, why did people, why was I persuaded to buy the stock? Like, you have to understand why you make certain actions. And it's better to know early, because because in the early stage, you're starting with like $100,000. But in the later stages, you're putting in 10,000, 50,000, and you're losing a lot more. Like it's better to learn these lessons at a much earlier age. So I think that's the basis of like my advice.
yeah. To be fair though, I think a lot of people actually aren't interested in stock analysis. I think it's difficult. You're often wrong, so you're not really getting the positive reinforcement. And I think most people are okay with an exchange traded fund or a mutual fund, but you have to get the right ones. You have to get the good ones.
Yeah.
Uh, Individual stock analysis, I think, is for people who enjoy it, and even then, I think they should have a significant amount of their portfolio in diversified mutual funds or ETFs. Uh, but yeah, I mean, education, I think, is like is the most important. I do get that, you come home from work after 8 hours at work or more. You probably commuted 45 minutes each way, and you want to eat and you want to play with your kids. To go on the computer and research stocks is probably, even if you to enjoy it, that's probably not your primary thing. So I do get that, uh, but I like, even an index ETF would be fine. You'd still be making that 7, 8, 9%,
Yep. Yep. That's
and
fine.
you'd be okay. The other thing I
Yeah.
wanted to mention, with Fire, there's different versions of it. I think there's like four or five. I'll mention a couple. There's like Lean Fire, which means you're living really a low end lifestyle. So you're probably out somewhere away from society. So the land is cheap or the rent is cheap. You're maybe growing your own food, and you're living on $20,000 a year, right? There's barista fire, as they call it, where you have some sort of a side hustle, but you're working part time. And then, of course, then there's Fat Fire, where you're still wanting to live on $100,000 a year, and so you have to have a pretty big portfolio in order to finance that. So it all also depends on what you want, how you would want to set things up. So
Yeah, and there's one more thing I want to mention as well. Like with a lot of investments, let's say your mutual funds, or if you talk to a financial advisor, always look at the MER or the fees that they charge. Like there are upfront fees, there are running costs, there's like loading fees. There's just so many fees they can throw at you. Like whenever you see fees in the word, just like ask questions. Like these are red flags. Like don't just like assume that's the norm of things. Like the norm is Vanguard, is where the fees are 0.03% or 0.1%, not 1.2%. Like there are some good funds that do charge 1%, but they must be like premium stuff with like 10-year track record and just outperforms the index like through and through.
yeah, absolutely. The fees eat away at the performance. So, and over many years, it will make a very significant difference. So you should be aware of the fees. The performance that you would see on any of the research sites is obviously after the fees come off. So you should be looking for performance, but the fees definitely subtract from performance, and people don't realize it. They don't know about the fees. There's thankfully a lot more disclosure these days, which was mandated by government. They've had kind of incremental disclosures, and so now your financial advisor has to let you know by letter, it's in your statements, how much they got from you.
Yeah.
So back 20 years ago when I started investing, I didn't know. And that taboo of talking about money is if I thought I would ask a financial advisor, how much do you get paid? How do you get paid? I thought, oh, it's like asking him about his salary, right? That's not polite. But it's all coming out of my pocket, so I should definitely know and make sure that I'm okay with it. So yeah, just awareness, right? Like I know everybody has something. Like somebody loves working on their car, right? Like if I were to have a car, I'd be like, no, it's dirty under the hood. I'm not reaching in there. So everybody has their thing that they enjoy, but also everybody should know at least a little bit about everything. Like I know how to change the oil on a car. I know how to change a tire. So everybody should know a little bit, at least, so somebody doesn't take advantage of you.
Yes. Yes.
So, and the same extends to investing. You don't have to be trading options. You don't have to be selling stocks or buying stocks, but you should know enough that in 40 years you'll have a comfortable retirement. So
Yeah, and by like knowing and researching, I think there's like a stat that says if you ever just read just 3 books on a certain topic, you know more than 95% of the people about that subject. That you you should like print this out and put it on a wall somewhere. Like just read 3 books on finance, and then you're good for life, and you can probably teach your kids that too. That's it. Like 3 books, a book a week, a book a month, whatever. Spend 3 months on it. It's
yeah,
worthwhile.
yeah. Read the Wealthy Barber.
Yep, that's a good one.
That's you
I got all of them here. Here's your Wealthy Barber, and then Rich Dad Poor Dad is a good one.
the book looks brand new. I don't see any dog-eared pages or anything.
Oh, yeah,
Yeah,
so
shiny.
shiny.
What up with that?
Well, that's for YouTube display only. Like my other collection is in your library right there.
The display model. That's right.
Yeah.
Yeah, just learn some of the basics, right? I think that's all I would suggest to anybody. And if you want to retire early, Absolutely. So let's move on to question number 14. Last but not least, it's a bit of a catch-all. Do you have anything else you would like to share with the viewing audience?
Yeah. Well, just what I said before, just read 3 books in this topic, even though it's so dry. Just go through it, grind through it, try to watch videos about it because some people like to recap on the books, and you can like really ingrain the certain like the important topics into your life. And then remember that slow and steady wins the race. It's okay to chase like shiny objects, like the home run plays, like the Teslas or certain weed stock. It's okay to chase it once in a while, but you gotta be mindful of like how much your wager is. You wouldn't go 100% on it. Like everyone's risk tolerance is different, but risk a little bit. Take the 1% risk, like take couple $100 and just take these home run plays. It might be your thing. Like if you find that over like a 2, 3, 5 year run that this is the way that like really makes you gains, then you can allocate more assets into that sector. But diversification is always key. Like people say dividend stocks, and then your growth stocks should be like much less than your dividend stocks. But it really depends on the person. For me, it could be 50-50. It's just what you're comfortable with. But then you need to start investing to know what you're comfortable with. Some people invest way too late that they just follow someone's path, and then they go to a financial advisor, they tell them exactly what to do, and then they charge you a hefty fee. Like that's what you're paying them to do, to find out your whole financial journey, where you can everyone and anyone can do it themselves. Like it doesn't take that much time or money. You can just start slow, as I mentioned before. Start with $100, one share of an index fund, one share of their favorite conglomerate, Coca-Cola or McDonald's. Like one share of anything. Just open a brokerage account, put your savings into that account, and start investing instead of putting it in a piggy bank or a TFSA account. It's just ridiculous to me, the TFSA account and what they do with it, and how the banks don't tell you that you can invest in that portfolio and what the benefits are. Yeah, so that's my take on investing.
Okay. I have a question, but because you mentioned the TFSA, I remembered I was watching an online conference, and there was a gentleman presenting. It was, I think, Canadian version of, usually they're US, but this one was Canadian. And it was a gentleman presenting who was billed as uh, kind of contributing and creating the TFSA. And he's like, oh, okay, this guy must know what he's doing if he created the TFSA. I'm like, I think he screwed so many millions of Canadians by calling it savings account, because now everybody has returns of a 0.5% on their
Less.
TFSA or less, right? I'm like, I'm not listening to this guy. he,
That's what not to do.
he, like he just screwed it up for so many people for 10 years plus, however long it's been around. But I was going to ask you, can you summarize kind of how your progression in investing vehicles was? For example, mutual fund stocks, options. What was kind of your progression? How did you go?
Yeah, I'm very different. I started with individual stocks. The first stock I bought like 15 years ago was Apple,
Okay.
and I I learned a lesson there as well that if I held on forever, like you find like something good and you hold on forever. But I got out of the trade maybe when it like tripled in value, and like once I got a couple of these like returns from say individual stocks, I just kept targeting individual stocks, and eventually I moved on to options where I know that if I'm right, I can, instead of get the 300%, like the 3x on the Apple, if I made the same play over the long run, I would have made 10x, 15x. But these are home run plays, and I know exactly how much risk is involved. And then eventually, it moved on to options on the other side where I sell these option contracts for like premiums. So in my mind, these are the dividends that
Mhm.
I collect. I never touched dividend stocks more than 5 years ago. I never thought about it because I wanted the growth. I wanted the 3x, I wanted the 5x or whatever, because that shortens my time of horizon of investing. But over time, when you start gaining a little bit more, I have that waterfall analogy again. So you take some off, you say you take 50% off, and then you put some in the dividends basket, you put some in the all weather baskets. That's just to like diversify your risk. And that's that was my run. And just recently I got into that bond and gold just because of the all weather portfolio,
Hmm.
or else I wouldn't touch it in my early stage. I mean,
Okay.
yeah.
Yeah. Okay. That's yeah. I think most people usually start out with mutual funds because that's what people at the branch, the financial advisors give you, and they might stick to them for the rest of their lives. I think these days maybe people could start with ETFs if they go out and do it themselves without a financial advisor. Then maybe people move on to stocks and options are that's I, yeah, I don't know. I, I I don't think very many people start with them,
No,
but
no, no. I didn't start with them either. I believe options like level 5, and individually in the investing in like index funds like level 1.
mm,
So you definitely need to build up your risk tolerance and how you handle losses before you touch options, I think.
yeah, but
Yeah.
I think because of the internet and all this information being out there, I think maybe people get into options and they
Way
they,
too early.
they didn't really build up to it with stocks but yeah, you also have to be, I think, smart about it and have 70-80% of your portfolio in something diversified,
Yeah.
and then you can play with the rest if that's what floats your boat.
Yeah.
But I've met some day traders. I through Meetup.com. I went on there and they were all kind of college kids. They were all coming from classes, going to the meetup while I'm coming from work. So, but yeah, they were day traders. They were day traders. They all got up at 5:30 in the morning, checked things, pre-market trading, and then anyway.
You
So
gotta emphasize things. What exactly are they checking?
I I don't know. At 5:30, I'm not coherent. I don't know about living on the West Coast if you want to be a day trader on Toronto or New York.
Yeah.
But yeah, I guess everybody kind of has their own thing, which you kind of gravitate to. Like for example, I haven't touched any futures, and
Yeah,
I've
me
never
neither.
bought options. I've sold options, like 30, 36 and counting, I think. But because like I'm the dividend person, right? So
Yes.
options are income,
Yeah.
and so it's kind of interesting how different people maybe you fall into it by accident, uh, and you just sort of learn. But it's yeah, everybody has to kind of find the vehicle that they're most comfortable with, and the other thing is like about 40% of my portfolio is mutual funds. Other than once every 2-3 months, I check that there's still 5 stars on Morningstar. Nothing. I don't do anything with them. The stocks, ETFs. Okay, let's see how they're moving. See if we want to buy more. See if we want to sell some. So a lot more um, hands-on, I guess, right? With options, I guess if I were buying them, it'd be a different story. But selling them, I just like, okay, do I need to buy the stock or is it going to be called a weather or what? So it's a lot simpler from that perspective.